Good morning to everyone in attendance here at the Orleans. And to everyone joining by Zoom, welcome to NAIOP, the Commercial Real Estate Development Association's breakfast program. I like this thing. I'm your 2026 President, Steve Niger. Before we begin today's program, I want to acknowledge something most of us probably haven't thought much about. As I briefly mentioned last month, after I did the chimes, that's my hype crew right there. As I briefly mentioned last month, NAIOP Southern Nevada turns 40 this year. Literally, in the month of June, 40 years ago, our chapter was incorporated. For the last 40 years, people have gathered under NAIOP banners, just like those, thousands of members, hundreds of programs and events, countless deals, partnerships, friendships, careers, and projects that helped shape Southern Nevada. One more. I want to thank my hype crew for encouraging me. Southern Nevada's entire skyline is full of fingerprints from people who sat in rooms just like this one. And while organizations evolve over time, it is worth recognizing and pausing to recognize the incredible legacy associated with the NAIOP name in Southern Nevada. Very few organizations maintain relevance, influence, and momentum for 40 years. But NAIOP has. Whatever your connection to NAIOP Southern Nevada, whether you've been involved or a member for 30 years or this is your first breakfast, thank you for being a part of this group's story. It is a good reminder that organizations are ultimately people, not logos, not brands, not names. It is the members that matter, so I'd simply like to thank everyone who helped build that legacy. Incredible staff like Katrina Bruce and Jonna Savage. Jonna, see her back there in the red? Thank you, Jonna. Committee leaders, board members, sponsors, members, in the words of last year's president, you the best. Big announcement coming on July 1st, followed by America's 250th birthday on July 4th, and a 40th birthday party in September. So be ready, save the date, September 10. We have over 280 people in the room this morning, so thank you for being here, and plenty of people on the Zoom camera. Today we have a special guest in our attendance. I'd like to recognize elected officials. We had Monica Larson from the City of Henderson. Councilwoman, are you here somewhere? Go ahead and stand and say hello. Thank you very much. And UNLV students. We also have UNLV students. If you are a UNLV student right now, please stand up and wave your hand. There we go. Please take the time to introduce yourself to them. They're wearing bright green ribbons. Thank you to our student sponsor, Heller Companies. And now we'll take a moment to honor our current President Circle sponsors. They are critical to the success of this chapter. Our platinum sponsors, Cox Business, Lincoln Property Company, Martin Harris Construction, and Snitzer Properties. Thank you to our platinums. I will golf clap it if I have to. Also want to thank our 11 golds, Burt Construction, Clark County Community and Economic Development, EBS Realty, Heller Companies, Howard Hughes, Kimley Horn, Majestic Realty, Prologis, Southern Nevada Water Authority, UES, and Unforgettable Coatings. Thank you to our golds. Now please check the screen as we recognize our silvers, our bronze, and our copper level President's Circle. Thank you all. And now to our committee announcements. We've got a couple. World's Best Volunteers, where are you? I think Tice O'Neill and Kelsey Higgins. Tice is up. Good morning.
Morning, everyone. I'm Tyce O'Neill with CBRE. I'm up here on behalf of the bus tour committee. So we have the event finalized. It'll be here at the Orleans, November 12th. Property submissions have been opened, and we've sent that email out. Deadline for property submissions is July 10th. So please, if you've worked on a project that you're proud of, please submit it and for us to review. And looking forward to seeing you guys in November. Thanks.
Short people here. You can stay up here with me. Kelsey's not here yet, so I'm going to do the DLI announcement. What class are you?
Class.
24, 25. Class of 2018. Who else stand up if you are a DLI graduate? Best class ever, Slack.
Not loud enough for DLI.
I saw Jen. All right, so DLI applications are out. The process has started. It's open. Applications are due July 10th. So that means any of you in the room that are 35 and under that did not stand as a DLI graduate should apply. If you have any questions about it, Tice would be happy to talk to you about it. I would be happy to talk to you about it. Jen Levine, Matt Hoyt, Slack, anybody in the room that has this light green on their badge would be happy to talk to you about it. Kelsey, anything else I can add for the DLI committee announcement? Please apply. And July 10th is the deadline. Let's keep it going. How many people? Steve is a graduate. I was, Matt was. So I think how many people in a row now? And Mariana's president-elect. So we have how many in a row that are DLI graduates that are presidents on the board? So if you have any questions, please let us know. And let's make another great class. Thank you.
And without paying $100,000 for a 4-year degree, it's the best education on this industry and a development process you are going to find. Thank you very much, Cassie and Tice. New member recognition. Each month we like to recognize our new members. If you are a new member, please stand and welcome to NAOP. New members, please stand up if you are here. There's some in the back. Thank you very much. If you see a red ribbon on their name tags, please make sure they feel welcome. You all know that this room is intimidating at 8 in the morning. Members make the difference. You can join anytime, so why not today? Seriously, why not today? That's all I'm going to say on the membership push this time. Thank you to our 2026 breakfast sponsors, and thank you to our Wi-Fi sponsor, Lincoln Property Group. Now on to today's sponsor. A special thank you to this morning's meeting sponsor, Carpenter, Seller, Delgado Architects, which is also one of our Copper President Circle sponsors. I'd like to introduce Mike Delgado, Vice President and Principal of Carpenter, Sellers, Delgado Architects. Welcome to the stage, Mike.
Good morning. Again, Carpenter, Sellers, Delgado Architects. We're a local full-service architecture and interior design firm, and want to acknowledge my partner Michelle, who's here today, my colleagues Vince, Deborah, and Roy. Please come say hello to us. We're very grateful to the relationships we have with all of you in this room. You guys have been our success. We'll celebrate 40 years at the end of this year, and we're very proud of that long-term relationships that we've had with all of you. Last summer when I was up here, I shared that we had a great project that would be going up across the street, the Culinary Health Center. Hopefully you guys have seen that as you come to meetings. We're very proud of that project. It's just about done. It's looking great. I also shared that we are in design on a project for Clark County across the street at Cameron, or at Arville for Clark County Fire Training Center. That project just started construction just in the last couple weeks. There'll be 4 new buildings on that campus. And I know there's a lot of graduates of the UNLV Lee Business School in this room, and you're all very proud of that. Also graduates of UNLV like myself. We're under design on the new Lee Business School building. We're in the design development phase, and that will start construction next year. So a lot of great stuff is happening. We appreciate being here today. If we can be of any assistance to you, please reach out. And again, enjoy the panel today. Enjoy your time with your friends. And we appreciate being here. Thank you so much.
Thank you, sir. Thank you again to our sponsor. Now on to the program. Reminder that for all of you here in the room, we have a Q&A session at the end of the program for our in-person attendees. There are notepads and pens at your tables to write down questions, which will be collected by Suzette LaGrange today. There she is. So she'll be looking for your questions on your papers, so please give them to her at the end. Thank you for doing that, Suzette. Q&A starts at 9, and our program concludes at 9:15 a.m. I am excited for our program today because I'm a broker. Brokers Roundtable, today's market, tomorrow's opportunity. I'm going to introduce today's moderator, Todd Manning, and he'll introduce our panelists. Come on up, Todd. Tad. Come on up, Todd. Todd Manning is a partner at NAI Excel and oversees the company's Las Vegas office. He's also a member of the Executive Leadership Board at NAI Global and helps guide the firm's strategy and initiatives across its 300-member offices. Todd began his commercial real estate career in 2005 and has been a Nevada resident since '91 and is also on our programs committee who coordinates our programs and speakers each month. You want to say something or have a seat and get the party started? Yeah. Whatever you like.
All right. Hey, good morning, everybody. This should be a great program. I'm really excited. We have a great panel, some really experienced agents on this panel, and this is really the group that's on the front lines dealing with tenants and investors and landlords and seeing what is happening in commercial real estate. So I will announce them, and then we'll get seated and we'll get started. Nick Barber, come on up. Nick Barber is a managing director at JLL, specializing in tenant representation, agency leasing, and office investment sales, with 22 years of experience as a licensed Nevada broker. Some might say this is the equivalent of a pickleball player who thinks they know how to play tennis. So please welcome Nick Barber.
Thanks, Todd.
Jen Levine, come on up. Jen is a partner with RealComm Advisors, who specializes in the sale and leasing of industrial properties and land since she began her career in 2005. Jen is a graduate of the first and best DLI class in 2009. It's in my bio. Okay, it's in the bio. She's chaired and served on multiple NAIOP committees and served on NAIOP's board of directors for 8 years. Jen is proud to have been honored with our Ellie Shattuck Award, our Associate Member of the Year Award, and a National NAIOP Volunteer of the Year Award. So please welcome Jen Levine. Adam Malan, come on up. Adam Malan is a vice chairman at Colliers International and is a leading advisor for retail developers, institutional owners, and private clients. During his 23 years in commercial real estate, he has closed over $3.3 billion in transaction volume and represents some of the most recognizable retail assets in Las Vegas. Please welcome Adam. Adam Schmitt, come on up. Adam leads the Las Vegas CBRE investment sales team, specializing in institutional assets in over 100 units. Since 2016, Adam and his team have facilitated 113 deals worth over $6 billion in total consideration. Please welcome Adam. All right, let me get to my seat. Everyone got your mics on?
Yes.
Check, check.
Check. Hello.
Check, check, check. All right, we've got you in alphabetical order here, and I've got a list of questions, so I apologize. I'm going to be reading these. I don't have it memorized like Hot Ones or any other YouTube show, so we'll just go off this. I'm going to start, Nick, with you, since you're closest to me. And the first question I have here are, our office market is very different from similar markets of our size. What are some of those misconceptions about the Las Vegas office market?
I think the biggest one right now is that we are, Phoenix, Orange County, or Salt Lake when you're dealing with tenants that are coming in from other markets. The main reason being is our occupancy's, significantly higher than those markets. We don't have a lot of half-empty new buildings. Most of our new product's been built and filled. And it's sticker shock for a lot of brokers that are coming in from like Dallas or New York, and they're like, wow, you guys are getting, 60, which would be equivalent to a $5 a foot rent. And the concessions have been compressed a lot, where they can get, a turnkey, a year free rent in one of those other markets. We're just not comparable to those. So I think that's the biggest misconception that I'm seeing on the landlord side. And then on the tenant side, the biggest misconception is the same thing, but trying to educate the tenants that it's not one of those markets.
What about on the sales side?
Yeah, the sales side, we've been a value add market forever. We don't have a ton of institutional owners. And so as these properties become stable, there's less meat on the bone, I guess would be the right thing to say. And it's really difficult to get anybody who knows anything about office in another market to pay, even a 9 cap for a stabilized office property, because they just don't believe the story's going to continue. So trades have been slim, with the exception of a few outliers. Most of our trades have been empty owner-user buildings or buildings that have been converted into condo air maps. And price per foot's been really strong, but they don't have a cap rate associated to them.
Sure.
Yeah.
Great. Jen, I'm going to jump over to you.
Okay.
Jen's our industrial representative on the panel. The last several years, really the last 10 years, we've seen incredible growth in industrial. The last 5 years has been phenomenal. Your specialization in more small bay industrial, a lot of the local businesses or small businesses, how has the explosive growth in industrial impacted those small bay users?
Well, in this development cycle, which started roughly in 2014, when Prologis, I think, took the leap of faith, about 70 million or so industrial square foot has been added to the market, and out of that, about this much has been small bay. Schnitzer and Heller have been two of the developers who have built something in the smaller space range. And when I'm talking smaller space, I do mostly things under 50,000, but really I'm talking like 10 or 5,000 and below, like really the small stuff that no one ever talks about. Very, very, very little product has been built in over 10 years. So while we have seen vacancy rates going up and a lot of people talking about the vacancy, we haven't seen that at all in our size range. It has remained really compressed because you have even more businesses than ever vying over the same amount of spaces, essentially, because there's been so little development in all of this time. It's kept our lease rates high, in some ways too high. But then the other part of it is, because industrial has been so overbuilt in the big box, industrial developers probably don't like me saying that, but those lease rates, we started to see them coming down, and a lot of higher concessions, increased commissions, things like that. And so we keep hearing tenants saying, but I heard lease rates are coming down. That has not been the case for our tenants. And even if they have softened just a smidge, it's from this historical high, not from where they signed their lease 3 to 5 years ago. And so we've had to do a lot of educating of tenants too when their leases turn, as to what you're hearing about in the market and the vacancy isn't in your space range, and it's an entirely different animal.
Speaking to that, what does it look like for a tenant today that's in 10,000 square feet of industrial and they've been on a legacy lease, and what are the opportunities for them to relocate, for them to renew? What does their lease rate look like? What are the occupancies out there?
It is honestly shocking how little there is out there, because I do everything. I do sales, leasing, landlord, tenant, buyer, seller, but I have been primarily landlord rep for a number of years now, and this year I've been a lot more on the tenant rep side and trying to do surveys for them. There's so little out there, especially if they have very particular ideas about what they're looking for. It's challenging. And their lease rates, I have one that was probably paying in the 90 cents, and in something 10,000 square feet, depending on where you are in the submarket, you could be up in the $1.40 range. It's a huge leap for them. And the same thing with the small guys too. They're having these massive leaps, which has been really a struggle for them. And we've had people just shutting down. And one of the trends I've seen in the last year and a half, which has been so odd, is tenants just calling us one day. Instead of the midnight move-outs in the recession, they'll call us and say, I don't need my space anymore. I'm going to give you the keys tomorrow. But you have 3 years left. Yeah, but I don't need it anymore. And they just actually expect that they can walk away. Before the last 6 months, we've been able to say, we'll go ahead and market your space for you. And if we can find an appropriate tenant, we will work out a termination with you, which is not that punitive for most of the landlords I've been working with, and we've been able to backfill their spaces. But that has been changing now. Whereas my smallest spaces, like the perfect little space with a reception and 2 offices, we used to say you could lease it within a month. Now we're saying 3-4 months. On the more problematic spaces, 4 to 6 months. It's taking a lot longer, so it has been more challenging, even though there isn't that much space. And I think it's partially because the lease rates have hit the max that these little tenants can handle.
Thank you, thank you. Adam, Malan, let's jump over to you in retail. Over the course of your career, you've probably seen a lot of trends in retail, whether it was the burger wars or the cupcake trend or, any number of users, the growth of dollar stores. What are some of the trends today, or is there a current trend that's kind of sweeping through retail right now?
Yeah, good morning. Thank you for having me. I want to give a quick shout out to my partner, Dina Marcello, who was supposed to be here today and couldn't make it, but appreciate you guys allowing me to participate. I know, as you were saying the question, in my head I'm going, I feel like we're still in the year of the chicken. But the chicken wars have been prominent and ongoing in terms of restaurant, but I feel that the general trend that we're seeing in retail is experiential. And that doesn't always mean, a escape room. It really is how retailers are delivering an experience to their customers, if that makes sense. Even when retail apocalypse was the catchword, 80% of retail sales still happen in the store, and people still want an experience. They might film themselves doing it these days, but they still want to interact with a human. They want to touch and feel. They want to have an experience in the store. So we're seeing retail kind of transform. Health and beauty is a big push in retail centers. Fitness. Historically, fitness was a no-no. Most of your anchor leases would restrict it, and it was hard to get fitness into retail environments. Fitness is a daily driver, second to a grocery store.
I'll send them all to you then. I keep getting
retail.
them.
There
I'll
you
send
go.
them your way.
But I think experience. I think that's the main trend in retail right now is creating an experience. I was reading something in preparation for this last night that talked about Ulta having like 11% year-over-year sales growth, and they attributed it back to an experience. They had, where you can go get your hair blown out or your makeup done in the store, but they created reasons for you to come in the store versus buy the same product online and increase in sales.
Excellent, excellent. Let me jump to Adam Schmitt on the end for multifamily. I'll ask you the same question that I asked Nick down here about misconceptions. What are the most common misconceptions about multifamily in Las Vegas?
Yeah, and I'd also like to shout out my partner, Justin Newbeck, who I don't think even showed up this morning, so that was nice of him. I think the biggest misconception that you see in my market and investment sales for multifamily is just people thought there would be this more robust level of distress for a lot of the properties bought in 21 and 22 with this floating rate, high leverage, debt fund debt, and that simply just hasn't materialized yet. And I think because of the reason that there's just a lot of this transitional debt capital that's priced relatively well. So you can look at the majority or even every deal that was bought in 21 or 22 or even parts of 23 and say, that's more than likely underwater, just based off of how they bought it, when they bought it, how the equity was all syndicated, right? But there seems to be just everyone can buy another 12 to 24 months. Lenders aren't necessarily willing to take that loss yet. As long as the borrower is willing to work with the lender, then it seems like people are willing to wait another 12 to 24 months. And I think that really coincides well with the story for multifamily in Vegas. When you look at supply dipping down for the next 2 years, at the same time you have this outsized job growth with the Hard Rock and the A's Stadium and Haas Automation and all of this. That's a really good story that's starting to permeate a little bit. So if you can wait 12 to 24 months and it's cheap to do so, then why wouldn't you? It works me out of a job, but I think ultimately it makes a lot of sense. So people thought there'd be this massive wave of distressed product, but it just simply hasn't materialized yet.
I'm gonna stick with you with another question, somewhat related to that. So there's been a massive wave of new supply in multifamily, similar to industrial. There's been a run-up of that over the last several years. We hear a lot of talk from economists and analysts that, for the last 10 or 15 years that we've been undersupplied in housing. How is it that we could be undersupplied in housing and be oversupplied in multifamily? Is it just a timing thing? Is it an affordability thing?
Yeah, I think that stat that we always see where we're 60,000 units short of housing is always attributable to that workforce population. What's being built right now is, we've averaged around 5,000 to 6,000 units per year for the last 4 years. What's being built right now is not serving that demographic, right? And that's not a knock at developers saying they don't care about that demographic. I think Ovation does a really good job at that. I think NRP has stepped in and done that. Nevada Hand has done a really good job at that. So that stuff is harder to pencil today. So that's really where the math works out, is in that kind of luxury Class A space. And that doesn't serve those folks in that workforce demographic that have seen, rents have backed off over the past few years, but we're still roughly 30% above where we were prior to COVID. You see inflation tick up. I think everyone's lives has gotten much more expensive, and that really hurts that workforce demographic. So you see those people, buddying up with roommates or moving back home or whatever it may be. So it's not as if there's 60,000 people all standing at a vacant piece of land waiting for apartments to go up, and it's like, all right, first 1,000 in line, get in there. It's really just trying to serve that need. So we are oversupplied relative to historical trends, but it's not necessarily the right product that's serving those folks that are just not able to afford the Class A rents.
Excellent, excellent. All right, Nick, I'm going to come back to you. What's the highest and best use for the U Center, that land? We'll just get right into it.
Thanks.
That's a big one.
It is. I'm sure everybody in this room knows about what's going on at Hughes Center. I think everybody up on this panel, his office there at one time or another. I think the highest and best use is keeping it primarily office, but reducing it. I don't think it needs 1.45 million square feet of office. But I do think there is an office component that's needed, and given our lack of inventory in the market right now, those buildings are really nice. If those buildings were on the west side of town, they'd all be 100% occupied. It's a geographical issue, and it always has been. And so I think the highest and best use is going to be to really, kind of energize what is already a mixed-use project, but less heavy on the office. The group that has been awarded the purchase is very energetic. They're very local, present, all the things that you need to be able to turn around a property like that. And I'm really excited and hopeful for what their plans are in the future.
Its current occupancy is 50, 45?
It's lower than that. It's probably in the mid-40s. And with the known vacates, it's going to push it down even lower. But the unique thing about that property is, as Lisa Brady can attest to, the tenants that are there love being there. They don't want to leave. I think that you've had a property in purgatory a little bit, and it's been bank owned for a couple of years. And I know Jeff Jacobs has been doing everything he can to keep that property humming, but you're still restricted to be able to get deals done. And so a lot of the tenants that are there are already talking about expanding or relocating. And again, given our lack of product, they're really nice buildings. They're just in a tough part of town, and you need the right team along with the right ownership to be able to convey that message that this is an area that they should be as they start to see the opportunities around town get shrunk. I do think, though, that the users in that building, there's going to be a new mix. I think it's going to be innovation, potentially R&D. There's going to be a medical component to it. I think that they're going to be able to feed off their proximity to UNLV, and it could become a really good hub, for occupancy.
How long does that process take? I mean, being optimistic.
I sound like I'm being interviewed by one of my buyers when they're underwriting one of the properties that I have.
What does the project look like in 10 years? Will it be at
I think in 10 years it'll be very different. If I just had to have a crystal ball, I don't think you're going to see many of the buildings on the north end, closer to the Spear there. I think you could see some redevelopment there. I think you might even potentially see an owner-user come in and potentially buy one of the buildings down the road. There's some uniqueness with that property and how the REA is, which is basically a CCNR. It's very unique, and it's a bit of a hornet's nest. But it's 55 acres, near the Strip. So it's kind of a Swiss Army knife from the standpoint of redevelopment and I think really getting, some new users down there that we haven't seen in our market. So I think in 10 years from now, it's going to be much more of an innovation hub than it's been like a quasi-Vegas, central business district.
Yeah, good stuff, good. Jen, coming back to you. Speaking of these small bay industrial users, what are the attributes of these properties that are most important to them? You mentioned that there's not been a lot of new development. Are these properties being remodeled to fit the new needs of these types of users, or is it mostly just higher rent?
Mostly higher rent. I would say, though, that most of these tenants just need a little bit of office and the rest warehouse. Like I said, there's the perfect little floor plan of a reception, 1 to 2 private offices, and then the rest warehouse. That I think over time we had built out a lot of office in the past. I can't get this to work right. We had built out way too much office in the past, and so now that is one thing that landlords are doing, which is kind of demoing some of the office and putting it back. We have Ampac Industrial Park in Henderson, which had a lot of that, where people went rogue building out office during I guess probably pre-recession, when there was a lot of heavy office in there as well. And so as we get spaces back, we've been converting them. But I'm seeing more and more small users wish they had dock high loading, because I think even the small guys are getting bigger deliveries than they used to with how global our economy is and how much shipping they're doing back and forth. But that doesn't exist very much, pretty much mostly under 5,000. There isn't anything dock high. There's a few at 4 and a few at 3,000, but mostly they don't have it. So they want basic spaces where trucks can get in and get out. They want nice office, which, thanks to Prologis, who set a trend also in the recession of white boxing spaces, as we've gotten them back over the years too, because a lot of these are older product now that's not shiny and new like everybody else. Our landlords have also gone in and white boxed them, painted the warehouses white, LED lights, fixed everything up, made them look brand new, and that's the new standard, which it never used to be. So,
if you were going to develop a project today for small bay users, what would it look like? Would they each have a fenced yard? How much office would they have compared to warehouse? Would they all have dock high?
If I could build anything
that is going to lease. It's going to lease.
Oh, I would say
easy.
5,000 or 6,000 square foot units with 1 or 2 docks and a grade all day long, both for sale and for lease. And if we could get anything further west, closer to Summerlin, because everybody wants to live close to where they or work close to where they live, and the bosses in Summerlin don't have anywhere to work. So Henderson, that's one of the reasons my project does really well. Is any boss that lives in Henderson, they would come to our Ampac project because it's one of the nicer ones. So if I could build something closer to Summerlin like that, that would be great. I mean, BD has been doing it, but their units tend to be larger size, and of course that's economics. How many demising walls can you put up? How many storefronts? How many restrooms? It's very expensive, but if you could make it pencil, I would go even smaller, even down to 4,000 with a dock and a grade.
All right, excellent. Adam, retail Adam, we'll jump back over to you. Let me ask the question. I'll ask you the same question I just asked Jen. If you were going to develop retail center today that's going to be successful, that's going to be in demand by tenants and users, it's going to be great for customers and just be a very viable project, what does that look like? What's the size of it? What's the layout? Who are the types of users that you're going to target? What's a successful retail center look like today? And maybe you could speak to the difference between suburban retail, neighborhood retail, high street, shopping center, major shopping center retail.
Yeah, good question. I mean, as I think about the term successful development, right, I have an economic hat and I have a shopping experience hat on. So, it's easy to look at what makes a successful development in terms of having synergistic and experiential uses that bring both a combination of daily needs to the shopping center and, restaurants, mid-tier shopping services, et cetera. So, I mean, number one, you're looking at location, traffic. You're looking at what you need for that daily needs driver. What we're seeing in our valley and what we're seeing across most major metros is that land cost, construction cost, and capital cost are making it very, very tough to develop large format centers. The bigger box rents don't pencil for the cost to develop in most cases. And so really what we're seeing in terms of the majority of what I'd call successful retail development is generally frontage, pad-oriented. The new coin phrase is essential service retail, which is essentially multi-tenant strip, fronting the street, daily needs retailers, not dependent upon an anchor for their draw. And so that's been a big push, both from a capital allocation in terms of what investors are looking for, as well as just what can really pencil and be delivered in today's market from a development perspective. In rare cases, we've got maybe 1, 2 being talked about here in town. You can pencil a 10 to 20 acre development with a traditional grocer box and supportive retail and pads. That's ideal. Very tough to pencil that in today's market.
You mentioned retail apocalypse, which was a term that maybe has been around for about 10 years. It started popping up in 2015, 16, and got a lot of buzz. At the time, I looked at vacancies back then. I think our market retail vacancy was around 7.5%. Today, it's 5%, 5.5%. Why is it that retail is still doing so well? And I know you mentioned a little bit the challenge of building some new retail. We see these big box retailers file for bankruptcy, and it seems like there's people ready to go. Is that just a scarcity of space?
Largely. I mean, I think the retail apocalypse was a fun catchphrase coming out of the great financial crisis that tried to explain really just a lot of other macroeconomic factors impacting retail. And frankly, leading into the GFC, Vegas was a prime example. The story was like we're expanding out 1 mile at a time, and there's a grocery anchored center every time you hit another section. And so we went through nationally and locally a large development period with retail in the early 2000s that kind of hit a wall. And whether it was market economics or dynamics, that is, from a standpoint of supply demand on occupancy, or really just rising costs that made it tougher to develop new product, we've had about a 10-year run since the retail apocalypse coin phrase where you haven't had much developed in retail. So what you're seeing today is kind of consumer dynamics that have held true and a substantial period of time with limited retail development. So to your point, you've got occupancy in the 95% range pretty much on average. That's not here, not just here locally, but really in most major metros across the country. And the fundamentals today in terms of the cost to develop, the cost to land, and the capital cost are going to keep retail vacancy rates very, very high, or occupancy rates very, very high. Retail vacancy, vacancy rates very, very low. I don't see a lot of forward development in the pipeline outside of development that's really pre-leased or specialty tenant specific.
Excellent. Excellent insight. All right, Adam Schmitt, let's jump over to multifamily. There's been some recent headlines about rental rates coming down in multifamily. We talked a little bit about the supply, the glut of supply in multifamily. Can you quantify what that means and maybe separate, the headlines from what's really happening?
Yeah, I think it's twofold. So the supply is definitely one part of it, and our 20-year average of supply is roughly 3,500 units per year. In 23, we did about 7,000. 24, we did 5,300. Last year was 6,300, and this year is another 5,200 or 5,300. So that's definitely one part of the equation. The other part of the equation is coming off the post-pandemic highs where you had this, call it government intervention as it relates to eviction moratoriums or rental assistance programs, so on and so forth. In the same year that you delivered 7,000 units, twice the 20-year average, you also peeled off those programs that allowed people to get evicted again or weren't able to pay their rent as effectively or efficiently anymore. So you had this sort of, we talked about the nice culmination of the next few years. It was this sort of worst case scenario where you had a plethora of evictions being processed at the same time you're adding record supply. So that's part of it, and we've really continued to add that supply at the same time the market's trying to rebalance from the pandemic and the post-pandemic. So that's all to say, rents are still up 30% from early 2020. They have backed off each of the last 2-3 years now. Market rents are down 3% year over year, but concessions are highly prevalent throughout the market. So effectively, 1 month free is another 8% off of your rent, right? And you see 2 months free or 10 weeks free in more heavily concentrated supply areas. So the headlines will say it's down 3%, but effectively, if you're getting 1 to 2, I've seen 4 months free at certain properties, effectively you're down much further. And that's just really a rebalancing. As I mentioned earlier, this is our last year of elevated supply. You get down to that 20-year average each of the next 2 years. So it's just working through the absorption, which is still, there's a lot of tailwinds that persist for multifamily demand as it relates to the single-family home unaffordability, where the delta between renting and owning is 160% in Las Vegas. That's a meaningful difference that keeps people in apartments longer. The first-time home buyer market is largely impossible. You still have strong population growth. You had year-over-year job growth, #1 in the nation from a total number of jobs, not just from a percentage. So that was rare for Vegas. I think Dallas rolls over in bed and creates 50,000 jobs, right? So to see us be #1 was great and encouraging. You're seeing the trend of visitation, year-over-year increases for the last 2 to 3 months. So that's all to say, you have this really good tailwinds for multifamily renter demand. It's just the supply is just something that we have to work through because we haven't seen levels of this ever in the market.
You mentioned on one of your comments earlier that everyone's been predicting this stress, and we see this headlines that rents are coming down, and you're talking about with concessions, it's actually even further. Mm-hmm. What does that look like to the underwriting for owners? How much of a hit is it? Are they still seeing black on their on their financials? Is it is it a big concern? Are we just kicking the can down the road, or is distress coming?
It depends on the debt and the timing of when you bought it and how you place the debt on it. So as I mentioned earlier, it's that debt fund debt that's largely tied to SOFR, which is largely tied to the Fed funds rate. That was when people were buying in 21. That was 0.05, right? And you were a spread of 300 basis points over that. So you're low threes on your debt, which essentially means at a neutral leverage or even negative leverage standpoint, you're around a 3. We were selling some high 2 cap rates back in 2021. Since then, as the Fed hiked rates, if you didn't buy the right cap on your rate, that went up 500 basis points. So instead of a 3% debt, you're paying 8% debt. At the same time, you have fundamentals going backwards. So there's a lot of red, but it really depends on the borrower. It depends on the lender. Some lenders have foreclosed. Others are willing to kick the can a little bit more. So it's very lender specific. It's very business plan specific. It's very sponsor specific. So it is very differentiated in all of those aspects. So unfortunately, the other part of it is that no one really wants to buy 70s and 80s product. No one wants to buy 8-foot ceiling product unless there's a massive cap rate associated with it. And you just don't have sellers of that number. So you have any distressed deal and it's 80s vintage, it's kind of east of UNLV, it's not a great location. You say, well, here's your distress. And they go, well, I don't want that. I want brand new construction at a 7 cap. So it's just hard to find that middle ground between how the property operates and that seller's expectations and ultimately where buyers are pricing deals today, because there's still rate volatility with geopolitical unrest in the Middle East, and at the same time trade outs are down, renewals are up but just slightly. So it's just hard to make the math all pencil, which is what the business boils down to.
I'm going to ask you one more question on
That's
that.
fine. Yes.
How many distress sales have you been involved in or seen over the last 2 years?
We have sold, we've gone to market with a few. We've sold 1. I'm telling people not to sell if they can hold on to it, which isn't good for my bank account, but I just think it's better advice to wait until the next 2 years. So you've seen a handful of foreclosures, but everyone was expecting this massive wave of this distressed product because you had 84 transactions trade in 2021, a lot of that with floating rate debt. You had 54 the next year, a lot of that in the first half of the year. And I was like, all right, great, that's 130 properties that in 3 to 5 years, those are going to be underwater. I'm going to buy them for 50 a door. And that just hasn't materialized. There's just a lot of different buffers that allow people to continue to hold. So we've done a handful. A handful is probably generous. We've done a couple. We've done a couple, and my competitors have largely done the same.
Yeah, excellent. And I'm going to come back to you on the same capital markets type investment questions. How many distressed sales have you seen in retail?
Not many. The term distressed and retail just aren't running on the same pathway in today's market. Value add is still very much what I hear every day from retail investors in terms of desire and appetite. Value add just looks different now. It used to be heavy vacancy or problem challenged real estate, and most of that's been worked through. We kind of joke internally, it's like if you find something with that deep a vacancy today, it might be a structural issue or it might be more of a fundamental issue with your real estate given how well the overall retail market has performed. Value add just looks different these days. Value add is more really deep dives into rent rolls, finding opportunities to push rents to market, finding spaces that you think you can upgrade. But distress, not much, if any.
Yeah. You mentioned the fundamentals in retail are really strong, occupancies are really high, rent growth has been fairly strong over the last 5-10 years. What about on the investment side? Where's the demand in our market for investment in retail? Is it obviously, single tenant net lease has continued to perform very well. What does the investment market look like here, and how do we compare to maybe the rest of the country?
Really good question. What we're seeing generally in the investment market in Las Vegas is a larger appetite from institutional and higher tier capital than we've really ever seen before. Vegas has always been an attractive market in terms of return potential, but a riskier deemed market when it comes to kind of our boom-bust history. I think across the board, we've seen just a immensely bigger appetite from institutional investors. It feels like in the world of larger capital, Vegas has grown up and certainly became a solid tier 2 market, if not a market that's pushing the tier 1 status in terms of how they're allocating capital. We have a couple of really large shopping centers on the market now, and it is encouraging to see the level of institutional publicly traded capital that not only has an appetite to be in Vegas, but has an appetite to push pricing, to do what it takes, so to speak, to enter the market. I think that's going to speak loudly going forward in terms of diversifying the ownership set in Las Vegas, diversifying the capital, and that kind of goes in bunches, right? It takes one guy to jump in the pool for everybody else to get in the pool, and so I think that what we're going to see is a lot more capital competing to enter the market. No shortage of interest in Las Vegas from the investment community. When you look at cap rates from a retail standpoint, grocery anchored, strong anchored centers are creeping into the high 5, certainly low 6 cap rate range, which is almost dislocated from where debt's at right now. So it speaks to how much demand there is to break into our market and buy assets. We're seeing people stretch.
Excellent. Jen, let me ask you, for small bay industrial, are there opportunities for private owners, occupiers to buy their own small bay industrial building? Do they tend to be part of larger developments? Do those opportunities exist?
Not very often, no. It tends to be, there's like 5,000 square foot buildings maybe up in North Las Vegas, usually with a little bit of yard. BD was doing the condo projects, but they tended to be around 10,000. I did sell a project once that had 1,200 square foot units, but it's very challenging for anything in the smaller space for anybody to purchase. And some of them would really like to do that, but it just doesn't exist.
What does the small bay industrial market look like over the next 10 years in Las Vegas? Is it going to get more and more scarce and difficult to occupy the space? Will there be more development? What does it look like 10 years from now?
I hope there's more development. I think what it's going to take is Schnitzer, because they're a long-term holder, they're a forever holder, where they can play the long game, because most people who are out there who are more merchant builders who are trying to build something and then flip it within 3 to 5 years, it just doesn't pencil. And like I said before, these lease rates, we've pushed them too high for some of these small guys, and where they have to put the lease rates to make these projects pencil doesn't work. So perhaps Schnitzer could go out there and build something knowing that it's going to take some time to work itself out, because we need more of this product for sure. And one more important point, which is the smaller the tenant, the more they care about their monthly nut. They don't care whether it's CAM or lease rate, they only care what their all-in is. And so CAMs have also jumped up quite a bit. We used to see them a lot, maybe in the 20-cent range in like Southwest Airport. And now you're seeing in mid-30s, sometimes even up in the 40s. And so when you do that, the lease rate has to come down in their mind, because it's their all-in that they care about, but landlords, of course, don't see it that way.
Excellent. Nick, back to office here. You mentioned we have a very healthy office market. We have, low vacancy rate relative to other office markets around the country. But we have a smaller office market in size relative to other markets, of our size. Who are the users that you mostly run across in our market, and what type of users are we not getting, and what do we need to do to start getting those users? Do you think we'll get them over the next 10 years?
It's an interesting question that's been asked to me for like 10 years. The boom of tech it just continued to absorb a lot of these buildings. Anybody who's driven to Salt Lake City, from Provo up to Salt Lake City, there's tons of brand new buildings with companies that you may have heard of or you may have not heard of, but they built for the tech boom. And they're in the mid-20s from a vacancy standpoint, so they have all these brand new beautiful buildings that are sitting half empty. We missed out on tech, but I look at it like you're on vacation in Mexico and you're having a margarita, but you realize you're in Tijuana. And so that's too slack. The reason why I say that is because we dodged a bullet by not having a huge tech boom. That was the biggest, the biggest loss from an occupancy standpoint during COVID. And now, if you read the layoffs across the board, hundreds of thousands of jobs are being removed by tech. So I think we dodged a bullet there. We have more suburban office. We have more, average tenant size anywhere from like 6,000 to 7,000 square feet. So we're not beholden to like the biggest layoff that I can think of we had was IGT laid off like 700 people. It was a rounding error. So we haven't had that mass exodus of these tech users. The reason why we weren't being sought after for tech was, we just aren't that, we just don't have that dynamic of a employee pool or educational pool. We have 2 universities, major universities in the state, so all of the talent has to be imported. But so that's enough about tech. Tech's been really crummy. But what we have seen is the space is getting modified for schools like Chamberlain, Arizona College of Nursing, Orbis, which is Grand Canyon University. All of those tenants have expanded in the last 24 months. You throw in Galen as well, which is an HCA group. It's like 500,000 square feet of just nursing college space throughout the valley. The problem with that is the fact you build out, office is really labor intensive. You're constantly turning it over. There's new trends. Everything's more expensive the next time around. It's not a box like what you guys have and what Adam has, where landlords Yeah, paint and flooring, and it's like the landlord tells you you can pay for your own TIs if you want more office. We just don't have that. We have to constantly adapt and spend a ton of money. And so when you do those schools, you know that you're taking a risk because you're building out a highly specialized space that's not very easy to convert if we have what happened with University of Phoenix happen, right? Where they just go completely under, shut down all their locations, and then the landlord's sitting there with a bunch of classroom space. So we've diversified. We're not a real estate and more, like at Central Point, for instance, like we were heavy real estate, heavy mortgage. We have a small percentage of that now. Lots of engineers, law firms are still growing. They're right sizing, and medical. Medical is expensive to build. It's cheaper to take an old office building and retrofit it. And we've seen a huge boom in medical users coming into office buildings as well.
Excellent, excellent. I've got one last question to ask, and then we're going to go to Q&A. And we're going to have to try and make this as brief as possible because I think we're running out of time here. If you could change, and I'll start with you, and we'll just run all the way down. If there's one thing that you could change or you would like to see us do in Las Vegas that would have the biggest benefit for our market over the next 10 years, for real estate, for the economy, what is something that we need to do better, we should start focusing on?
Just as somebody who's lived here forever, I wish we could really figure out the frickin' construction in this town on the roads. I've been saying it for 30 plus years. It's a nightmare. I don't get it, but whatever. But as an office broker, I really wish that the county was more like the city from the standpoint of like a master plan. I drive cities where office parks are beautiful, sprawling, and then they might lead into some retail that supports it, or they might lead into some mixed-use project that supports it. And we like build a merchant office building, and we've got a data center next to it, or we've got this massive, no offense, but we got this massive industrial project next to it. And the county, unfortunately, is where most of the land's at, where people want to office, because Summerlin is, its own bubble, and that's what I wish we could see. And I wish the prices for the land were cheaper so we could see some more office development, because I do think we have enough demand. But
good.
Yeah, that would be my.
Jen, same question, but more brief on your answer.
Well, dangerous is my...
No offense, Nick. That was great.
No worries.
That was great.
Dangerous is my middle name. But maybe this is crazy, but I wish people would think more long-term, big picture. I know everybody wants to push rates, and get everything now, including land prices. But big picture is maybe if we went just a little bit slower, we would have this healthier growth, more successful businesses, less vacancy, less turnover, all of that.
Good luck. Good luck. Okay, that was good.
Way shorter than me.
That was good.
I would say, briefly, and it's a large topic and one that NAIOP has been championing for a long time. But really, it's just land constraints. And solving that over the next 10 years is a really big deal. We're going to hit the walls and have to come in, and infill is expensive, which is land values. And we don't have today the wage base that can afford, on a residential rent or a commercial rent, the increase in land values due to land constraints. We've got to solve that.
Great insight. Adam, same question.
I think we touched on it. I think education and bolstering the growth there, and just being able to be more taken more seriously as a more tier 1 or even kind of higher tier 2 market would be massive for this market. Obviously, people still see us as this hospitality driven market, which is true to an effect, and we've diversified as well. But I think if you're able to, in our business, we always say the mantra is that the companies follow the millennials and the investors follow the companies. So if you're able to get better job growth with more higher end, whether it's tech or medical, whatever it may be, just a better, more diversified, educated workforce, I think you'd see more headquarter expansions, you'd see different, more satellite offices, and just different industries that support higher cost of living or whatever it may be. So I think focusing on education, whether that's bolstering UNLV or whatever it may be, has always been a weak point, I think has been in our market, is the education.
Excellent. All right, we're right at 9. How much time do we have for Q&A? Okay.
Take 15 minutes?
Did anybody get me a chocolate muffin this morning? I need one. I want to throw that out there before the end.
Do we need some help with the mic?
You can have mine.
Oh, there we are.
There we go.
Okay. Our first question is about redevelopment and conversion. And the question is, are there redevelopment or conversion incentives from the state, county, or the municipals that have been particularly helpful to projects penciling out? And what kinds of incentives would be more helpful? And there's a second question that I think might kind of bring some things together here. So we'll ask them together, and then you guys can expand. When are we going to see office buildings on the east side of town redeveloped, high vacancy, deferred maintenance, location obsolescence? All of these hinder their lease-ups at this time. So we'll start off with those questions.
Nick,
Easy
sounds
ones.
like it's you.
Well, yeah, so redevelopment, the one project that I can talk about is the Grant Sawyer building. My partner Travis is selling that building for the state to Lange. They're going to do affordable housing along with Cashman. They're going to scrape that building. I think they might have already started. I know that there was a unique thing within the escrow. But I had this question asked to me a while ago, like, are we going to do conversions to apartments or
Industrial.
Yeah, and we just haven't. We didn't overbuild. So conversions for office, the thing that you're seeing converting is mixed-use tenant to owner-user or mixed-use tenant to office condo. That's the biggest conversions that I'm seeing. As far as the east side, I got no idea. I don't know what to do. I don't. I used to list a lot of those properties back in the day. I think there's still a need for them. Not everybody can office in downtown Summerlin or the Southwest or Henderson. So, yeah, I don't have an answer for that. I wish I did, but I don't. Sorry.
Justin's here, by the way. He showed up. He
thank
wouldn't miss a free breakfast.
All right. The next question is, we'd like to see some highlights of retailers that are experiencing growth and success in the market. Anyone can take that one.
I'll take that.
Yeah, Adam, I think that.
I mean, we've seen a lot of retailers with success in the market. Restaurants have done really well in the market. We've seen a lot of new concepts entering the market. You've had a lot of new grocery growth in the market. Hispanic grocers and ethnic grocers in particular. I think you've got 4 or 5 strong brands in town, and all of them are adding stores. So you've seen an expansion in grocery. You've seen a ton of convenience-oriented, whether it's fast food, whether it's C-store gas, very in vogue, and a ton of that development happening. I mentioned earlier, I mean, health and fitness, health and beauty is probably bigger than it's ever been in retail. And so, the med spa concepts, the IV peptide type concepts, we're seeing a lot of that.
Are we still seeing companies? Are we still seeing companies from California coming here to relocate in Southern Nevada? And how do we compete with Salt Lake City, Phoenix, and Denver as a competitive market?
Well, even in the small space market, yes, we're still seeing companies come here from California. But my small guys we're not necessarily shopping for the different markets like the big box guys are.
Education would help.
100%.
Yep.
How are office condos affecting our market?
They've been great. We're seeing some of the highest price per foot, sales. Most of them are sub 10,000 square feet, but we've seen as high as like $700 a foot to, mid fives, depending on the part of town. They've been great. I do think we're getting to a bit of a saturation point, though. I think everybody had the wind at their back, and there's been some really incredibly successful projects, and now everybody's coming out with the same thing. And I just personally don't know if we have enough demand, but it's been really good, and it's also taken a lot of supply off the market, which has allowed owners that have multi-tenant for lease space to increase their rents and reduce their concessions.
Okay, we've all seen and heard the stories of malls from decades ago that used to be thriving but are now struggling nationwide. And seeing our local malls, this question says they're wondering what's being done here to counter the trend, and what are some other uses for them besides the redevelopment they've seen so far?
You know, I think the general trend that we're seeing with turnaround malls is the incorporation of ancillary uses. I mean, malls have become mixed-use developments. You can't really revive a mall just by bringing in new retailers. You've got to bring bodies to the site, and daily bodies to the site. So we're seeing nationally a lot of that is either utilizing surplus parking fields or demolishing certain boxes and bringing in multifamily and office. Daily needs, daily reasons to be there that'll drive retail. But malls are shifting. Malls will likely in most cases never be this 3 department stores and all your mid-tier fashion retailers. Malls are turning into experiences. Malls need to have bodies on site, whether that be from an office perspective or a residential perspective. Candidly, we haven't seen much of that in our market. We're not over-malled, and like the Meadows Mall is just hanging on, producing cash flow. Boulevard Mall traded a long time ago and has had some of those interesting or mixed uses put into it.
They've actually done,
they've done really well, right? Mm-hmm. The Galleria Mall traded and has continued to do well and thrive. So luckily we've dodged some of the bullets here, but I think in general you got to bring in additional uses to those malls.
Okay. And the last question that we have this morning is about land. They want to know when will we see more land be available and potentially prices coming down?
Your NAIOP Government Affairs Committee is heavily lobbying all the time. Get involved, speak up.
I don't think it's coming down.
Land and construction costs, two things that typically don't come down.
Nope.
We say it all the time. I mean, even when rents get pressured, even when development costs make development not feasible, land sellers are the last to react. And typically, most of them haven't reacted until the market just kind of catches up to them again.
And they've owned it forever in some cases, or they bought it right, and they're just going to hold on and wait. It makes it really difficult for development. It really does.
I'd be curious to hear your comments on that. I feel like everybody thinks that the multifamily guys can pay whatever it takes, and it's very tough these days to find anything in my mind that pencils.
Yeah, obviously we have a lot of supply, so people have found a way, but a lot of that is concentrated in the higher end product because that's simply how it all pencils. Yeah. It all boils down to a pro forma. And you've seen people try to push the envelope a little bit too much on those high-end rents, and I think you've seen that Vegas can't necessarily support all of that in mass. So you've seen those really high-end communities. We're talking the $2,300 one bedrooms, the $3,000 two bedrooms, all being built at the same time in the same locations have just added in a lot of higher-end concessions, 2 months to 3 months free. So, the multifamily guys still tend to find a way. Home builders are sometimes beating them out. But like I said, you're seeing supply drop off for the next 2 years, so perhaps that it's coming to an end a bit.
Very interesting.
All right, and so that was all of the questions from the audience, and our final question will actually be from our UNLV student question.
Thank you. Paris Carton, my main question was, what is the one deal type or submarket that you think is generally mispriced, either as an opportunity or as a risk?
I'll start with that. That's a good question. I think what I alluded to earlier was just the lack of appetite for 70s and 80s workforce product. I think that just based on our demographic makeup as a market supports kind of call it need-based housing or renters by necessity, and because there's so much capital that's crowding into Class A space, well-located deals, 2010s and newers, 9-foot ceilings, I think you're, as a product type, able to capture the masses instead of the classes. And at the same time, because you have less appetite for that product, it generally becomes cap rate expansion territory where you're able to get some good yield on this product that likely stays full, provided people pay you. And I think that's an opportunity that's a little bit mispriced right now just because there aren't a lot of comps, because there's not a lot of buyers, and you just don't have sellers at 6+ cap rates right now. But once return expectations reset a little bit, I think those opportunities will be seen as really good buys in this environment today.
Yeah, I'll follow up on that. I mean, I think that, and answer it in a little different way, I think that existing real estate, I don't want to say is mispriced, but when you look at existing real estate relative to the land constraints we've talked about and the capital cost and the construction cost that we've talked about, like rents have nowhere to go but up if we want to develop more product. And existing real estate, even as you look at like a cap rate valuation relative to debt cost today, you kind of hit your stop gaps. But I really feel that existing real estate on a price per pound basis is a great opportunity today. Again, for us to develop new product, rents have to push. I think to buy a property that you like today, for your neighbor to build something and compete with you, it's going to be significantly more expensive and it's going to push rents. So I think that real estate's undervalued.
All right, fantastic. Great job, great insight, all of you. I hope everyone enjoyed it, and thank you again for attending. Thank you for being available.
Thanks,
and
Todd.
being part of this.
Thank you.
Thanks,
Another round
everybody.
of applause. Thank you.
Thank you again to the speakers, our program sponsor, Carpenter, Sellers, Delgado Architects, and all of you for attending the meeting this morning. Hope to see you here Thursday, July 16th for the next breakfast. There's a great day out there somewhere. Go get it. Thank you very much.